Bond yields getting a major boost from May's blockbuster jobs report. The yield on the 10-year benchmark topping 4.4% today. And joining us now is Kelsey Berro, fixed income portfolio manager at JPMorgan Asset Management. And thank you for joining us here today. You know, we didn't get the biggest reaction in stocks. The initial reaction was down, but the huge movement that I was tracking was in the bond movement. In the bond market, the 10-year up 15 basis points. That is the biggest jump in a couple months. What do you think this is signaling?
So certainly the markets right now are anticipating and have now had to readjust in terms of their expectations for the Fed later this year. So essentially, you know, there's a couple things that I saw in the jobs report today. I look at jobs itself. They were coming in hotter than expected. Wages also came in hotter than expected. Really, the only thing that was a little bit of a fly in the ointment was the tick up in the unemployment rate. So we have seen a gradual rise in the unemployment rate over the last, let's say, 6 months. The low was 3.4. Now we're at 4%. That's not concerning in and of itself. But it's just telling the Fed that they shouldn't be in any rush to ease policy. Now, for a fixed income investor, what we're a bit more focused on is not as much about when they're going to cut rates, but more the fact that they're done hiking rates. And that's a function of the decline in inflation we've seen. And so, you know, the next market event for investors to look forward to, in addition to the Fed on Wednesday, is CPI.
Right.
And that's going to be really critical.
Is there any doubt that they're done hiking rates?
Well, I think there is still a debate about if the Fed is right to be thinking about cutting rates, and is policy really restrictive? So in world, you know, there's still this debate over, is it a hard landing? Is it a soft landing? And I just want to dispel that myth and say, the soft landing already happened.
You're the second person who said that this week.
Really?
Yeah, that's so funny.
But here's how I'd extend the analogy. Mm-hmm. So we've landed, but the plane is still moving on the ground, and we're looking to taxi towards the gate, and we're still questioning, are we going to crash into the gate? Are we going to stop short of the gate? Or are we going to get right to the gate and have a nice entrance into the airport? So that's really still what the market is grappling with. And that's why you see these very intense moves in the bond market, because there is still a lot of uncertainty about how that taxi process is going to go forward.
Arguments, every month we deal with arguments and criticism about the way the reports are conducted. And to be fair, the survey response rates have gone down over the last few years since the pandemic. But there are two surveys. You have the establishment survey for businesses, the household survey for households, and they've been saying different things. What do you say to that?
Well, that is a really interesting observation. And when I talked about the different parts of the jobs report, you have the non-farm payrolls, which comes from the business survey, and then you have the unemployment rate, which comes from the household survey. The business survey had strong job growth, and the household survey is showing the unemployment rate rising. So that's a little bit of mixed signals. So what we try to do is take a little bit more of a mosaic approach, not just overweight one specific data point, but look more broadly about how things are going. And to us, what is most clear about the labor market is that it is rebalancing fairly significantly. You know, my favorite indicators are particularly in the JOLTS report, the job opening labor turnover survey. We've seen the decline in job openings and the decline in quits, and wages start to roll over. It's not a sign that the labor market is falling off a cliff, but it is a sign that in a way, things are moving into a more healthy balance.
And so all of that said, then do you think that today's move in the bond market is an overreaction? It sounds like maybe so.
Maybe a little bit on a one-day view, but you also have to remember we rallied a lot. Yields moved fairly substantially in the past few weeks in ahead of the jobs report. We had some very soft data on the survey side that was getting the markets a little bit concerned. So if you look over a longer period of time, I think we're still kind of in a reasonable range. The market is pricing in 1.5 cuts for this year, so that's between 1 and 2, and about 6 or 7 cuts in total over the cycle. So I think this move today was large in and of itself. We did see a large rally going into the report, and overall, I think the market is still reasonably priced based on our expectations that inflation is under control, and that will allow the Fed to cut in the fall.